I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. This is your host, Dylan Marma, and today we are joined by a guest that I have known for several years, since back when I was living in East Tennessee. Someone that's been a very active investor there, Mr. Greg Scully. So welcome to the show, Greg.
Thank you, Dylan. Pleasure to be here. How are you?
I'm doing great. It's great to have you here. So I'll just give a quick background for the listeners. So Greg started investing in 2016, and he's been full-time since 2019. He is focused where he's living and very active as boots on the ground in Central and Eastern Tennessee. He's participated in all different deal types, a lot of multifamily, syndications, joint ventures, done some house flipping, and more recently, he has also gotten into RV resorts. And we had the pleasure of working on a project in East Tennessee together. So we are very excited about one of our properties that we're working on together there in the Smoky Mountain portfolio. So when he's not investing in real estate or underwriting, him and his wife enjoy hiking and trying not to talk about real estate, which I'm sure isn't always easy. So, so Greg, why don't you just start off and just tell us a little bit on how you got your start?
Yeah, got the initial start was back in Alaska at a Fan Merrill flip his house thing. We had a small business, so we kind of had the entrepreneurial streak. As I was sunsetting out of a 20-year W-2 career, we started to look at entrepreneur opportunities. We ended up opening a small store back in Palmer, Alaska. That didn't go super well, so we started to look at other things. And lo and behold, watching TV, I'm like, okay, cool. I'm going to go to that and just go down the rabbit hole a little bit. So that was my initial introduction. And from there, we just piled on into the education side of it, joined a couple of education platforms, did some financial trickery back home, sold the business. We just closed the business, refied a home. I blew up my 401k, liquidated my pension, changed jobs, did all of that stuff to try and create some capital. And so our first couple investments were on the passive side, a couple of turnkey single family homes out of Memphis, Tennessee. And we also invested as an LP in a syndication before we ended up being active on our first deal here in Johnson City, Tennessee.
Fantastic. So taking that route of going the LP route first, how do you think that helped you along the way?
I wanted, that peek behind the curtain type thing, just to see how the syndication side of it went, and also just see are we comfortable with this asset class and how things would evolve with returns and all of that. So it's like, okay, we got to put some of this capital to work. I didn't feel quite ready to dive in from the education side of it. I wanted to spend more time figuring all of this out. So it helped just because you were able to see everybody or somebody else's OM and their market research and their analysis. And so you kind of got a good look at how the whole process is put together and ultimately what you come up with in order to talk to potential limited partners or even just, people you want to invest with.
Mm-hmm. So getting into the first property that you worked on there in Johnson City, is that the one that you recently sold?
Yeah, we sold it actually about a year ago.
Okay.
No, not quite that long ago. Tail end of 2021.
Mm-hmm. Great. So you initially started buying, and you were using third-party management at the time, right? Sounds like you had
Yep.
a couple of great early, successes with some of the properties that you're working on there. And then recently, you've also decided to burden yourself with bringing management in-house. So tell
Yeah.
us about that. What's inspired that decision? Was it some of issues you ran into from working with third parties along the way, or was it more just like wanting to have a better understanding of what's going on, visibility?
Yeah, I mean, it's a short list of things. Ultimately, our third-party manager was actually extremely helpful. We had a difficult project. That first project we got into proved to be very difficult, and they were extraordinary in helping us get through that, and then eventually exiting. But it comes down to trade-offs and limitations. So there's trade-offs with third-party management. It will cost you a bit more, but you'll have to do a whole heck of a lot less, and you can settle back into that more of an asset manager role, being the manager of managers. But the limitation side of it is a fairly large company here locally. They've got a lot of systems. We were more interested in doing things like RUBS or online leasing, things that were fairly new to them and may have required them to change some systems.
Mm-hmm.
And so from their point of view, especially now that we're property managing ourselves, I completely understand why a property manager would not want to have specific requests from one specific owner that is 3% of their portfolio. They don't want to have a different system for every owner for every property. So there was not necessarily pushback. They were willing to try it, but the time frames and the execution of it just never were what we hoped. So we're like, okay, well, we'll just take this in house.
Awesome. Yeah, I definitely agree with that. I think there's are pretty clear pros and cons with third-party management, right? And the benefit is, especially when you're getting started, is that it allows you to focus more time on finding deals, putting together capital, and the probably higher income earning activities, right? We would say higher output activities. But then on the con side, you have, like you said, they kind of put you into a box, and it's basically, hey, this is how we do things. And to your point, I completely agree. I could not personally imagine being a third party manager in general, and the idea of having to, if you have to change your system to accommodate every client, if you have 50 clients, I bet you have 50 different systems that you're following by the end of it all, right? Because I'm sure everyone has their own unique ways of how we should do this or that, right? So I think that's a really good point you bring up, and probably something that doesn't get talked about all that much, is that when you work with third party, you have to realize that you're sort of going to be operating the property how they operate, right? There's only so much flexibility that you have. I mean, obviously, the larger you grow and the more of your, like you said, the more of their portfolio you own, the more of a open mind they probably will have towards these ideas. But I think it's empathizing with them and understanding what they're going through, right? And they can't just move and kind of be flexible to every single suggestion you have. Otherwise, their life would be extremely chaotic. But also just realizing, that it's just a trade-off that comes with the territory. And there are sort of some pros and cons along the way. And I think every operator has to sort of get a better feel for where they gravitate and what's best for them, because there's plenty of people I know that would never even consider property management because it's not really a high margin business. I mean, for us, it's never been a profit stream, probably never will be. And, but it's more of the control. It's more of the visibility of what's going on in the process. And like you said, the idea of being able to sort of test and measure new techniques and strategies to kind of keep ourselves up to speed with modern, technology and practices and things along those lines. So maybe in your case, you want to speak toward just maybe any eye-opening realizations as you started to manage yourself?
The spreadsheet turns into people very quickly. So, we spend a lot of time on business planning and pro formas and rents going up and expenses doing this and things showing up on time and things like that. But ultimately, these places are occupied by people. And that was my biggest learning curve and continues to be so far is how do you interact with human beings? And answering that phone call about this or that and having to explain changes of policy, why we need to do this, with a renewal lease. There is a lot of amateur psychology going on. And ultimately, the property management side is the business facing side to the public, and it's very much people business. And I think that gets, overlooked a lot when we're putting together these pro formas and stuff, and look how great this is all going to run on paper. That has to get implemented somehow. And that's where things get, I don't want to say messy there. It's incredibly dynamic.
Mm-hmm. Yeah, that's interesting, right? It's once you tear down the silos of your sort of finance, asset management, acquisitions arm, and you are fully integrated, right? Like I always like to say, like we are an operations business first, right? That just happens to need capital and acquisitions to grow. But I think that once you tear down the silos, it starts to you start to be a lot more thoughtful about the assumptions that you're using and how that's going to be received, your capital improvement projects and things like that. Would you say it's had a pretty big impact on the way that you look at deals from the get-go and underwrite?
It's starting to now. I mean, just in basic biases and heuristics, and we tend to overestimate what we can accomplish at prices that are underestimated. That I think we're all guilty of that to some extent. And that, just shows its head a lot more when you're in it day to day.
Especially on the expense side, is that what you're saying?
Especially on the expense side, or, when you're on property, because we're extremely active. I mean, I was out at the property today waiting for the asphalt guy to show up and, help tore down some decks while I was waiting. Yeah. And, that you're seeing a ledger board come off the building and seeing some insect damage that you didn't know was there. And you're like, well, there's the contingency line, just reared its head right there.
Uh-huh.
So, and then, I'm sure you're well aware, labor is still a bit of a wild card right now. And getting skilled people to show up on a consistent basis and keep things on a reasonable timeline continues to be challenging. So yeah, just having very realistic and well padded expectations of what we're going to be capable of doing and making sure you're capitalized.
Completely. Makes perfect sense. And I definitely can relate. I think when I first started in the business, I definitely underestimated what some of these capital improvements would take on time or costs, right? And I now I always realize that most things take twice as much time and sometimes twice as much money as you initially expect, right? So I think that as you're really in the thick of it, you start to really become probably much more conservative on your expectations for things, because you realize that, like, to your point, right now there's material shortages, there's labor shortages. I mean, I have things that, I think we can take 8 months, but I'm budgeting 2 years for, just because I know that there's going to be all kinds of red tape we're dealing with, or, different things that will come up along the way. Right. So I think I think that seeing that firsthand, and it probably being more intimately involved with the headaches that come along with it, you start to realize that some of these things that, you might just, if you're just sitting there behind the Excel spreadsheet, you might just think are, quick and easy fixes are certainly much much more complex.
Yeah, I mean, I think you just develop a much more holistic point of view on the project in its entirety. Because we're seeing ebbs and flows between stuff that we budgeted. It's like, oh, well, hey, the dog park came under budget.
Mhm.
Okay, the pavement came up a little bit more than we expected. And then that's actually just comparing quotes from pre-acquisition 2 quarters ago.
Yep.
Commodities are a lot more expensive today than they were, especially when you're talking about anything with petroleum in it. So, asphalt costs went up and we had a little bit of extra padding on the dog park. So when all things kind of blend out, you're like, okay, we're still tracking as a whole. Sometimes it can be a little frustrating to look at individual line items because you might see some struggle there. But yeah, you just kind of looking at what adjustments based on what just happened here can we make moving forward to maybe make up for some of that. And so on. It goes back to that dynamic thing. You can't
Completely.
force things to fit your budget, or you're going to
Uh,
cut corners, which might come back to bite you in the ass even more. I mean, there's nothing worse than doing a job twice and paying for it twice. Yeah,
Completely. Yeah. And I think the best advice I'd have for anyone that's, early on, that's an active operator, or if you plan on doing your own deals or syndicating, whatever it might be, is just always pad the budget, right? Like definitely always building contingency. Obviously do your best to get quotes and get specific in the beginning, but when you're in real time in the game, right, there's things that you didn't see coming, and you want to make sure you have the liquidity to be effective on the way, right?
yeah. Like even just an aggregate point of view, I'm starting to think about that with quotes a little bit, especially bigger stuff that you get in advance. You might get 3 quotes for maybe a septic system or something, Dylan. And one quote might be the lowest. Hopefully that's the one that pans out, but that lowest quote won't go into the pro forma. Maybe you'll do an aggregate of the cost of the 3, say like, okay, that's what we think is going to be the cost. And there's going to be a contingency on top of that somewhere else, just in the total CapEx budget. So, just little things like that help just add a little more padding, but it's very easy just to blow up a CapEx budget and be like, there's no way we can do this. It's going to cost 3 times the price of the building. So, you trying to find that balance between being prudent and just pricing yourself out of an opportunity.
Yeah, there's definitely a delicate balance. But the thing is, you can always return money, right? If you
exactly.
over budget or over raise, but you can't go and get more of it, right? So I think it's always leaning on the high side is always, I think, in the best interest of the operator, right? So now with the property management side, is if there was one thing you could have told yourself or known before getting involved, what would that advice look like?
Just the time frame of, you have to start a business, you have to get an entire business set up, you have to onboard with the brand new software company that you may or may not have a lot of experience with. Just how much time that takes, it's an incredible amount of time. And I'm sure anytime you buy a property, there are a significant amount of one-off tasks that have to be done in order to get something up and going. So I think we kind of knew it was all there, but we kind of underestimated how much time that would take. So we're about is it March 8th? So we're 3 months into one property, or 2 months in a week, and about 4 months into the other. And it's just now that I feel like we're getting really finally over the hump of all the acquisition stuff that goes into getting up and running. We'll get better at it because this is our first crack. But I think it's safe to assume it'll take you a full quarter to get up to speed and get something running.
Definitely easily. And even after you have your systems, that there's always usually a few months of getting sort of settled in on the property, right? Getting a feel for the current staff, getting a feel for what's really going on. You have kind of the skeletons in the closet that start to come about, in the first few months, and then you have even more that keep coming up over the first year, that you can only find out when you're really in the thick of it, right? So as much as you want to be thorough in diligence, you have to be prepared for things to come up in those first few months, right? And getting to really know the place.
Oh yeah, yeah. There's going to be them. There's going to be a lot of them.
So shifting gears to, I want to talk about multifamily, and then I want to talk about some of the more recent stuff we've been working on in the RV campground space. But starting with multifamily, what's your take on today's market? I always like to hear this. I feel like there's a lot of different opinions about it right now. So where do you feel like the opportunity lies? Where's the biggest risk? And how are you navigating today's market?
I mean, little Johnson City, Tennessee here, apparently we got found out because there was recently a property we toured, we looked at, we were like, this looks pretty cool. Fully marketed, had a whisper price, called the offers came. I didn't even offer on it. I'm like, we are so well below the whisper price on this. And I know these guys, and I put little emphasis on a whisper price, but I think the data would probably show that these guys are usually pretty close with that's where it's going to be traded. And so I called back and I was like, okay, without disclosing anything you can't disclose, where did it go? And did hard money have to be put down on it? Because those were two things that we hadn't had to do in this market. So it went well over the whisper price, and multiple parties were putting six figures down like day one. I'm like, okay, that's kind of not us. We're not in that position. Our capital has different needs. So I think a lot of the risk is FOMO, maybe, fear of missing out. And I'm not just going to buy some because I feel like that's where the market is at, and it just might not buy much. It's just or try and pursue off-market stuff or stuff that's not fully marketed. I mean, we do get looks. I don't think we ever see anything that's truly off-market, but they may be pre-marketing it to people that they know are in the area, and just trying to take advantage of those opportunities. One thing that we kind of talked about as a group, Real Wealth Solutions, wherever that is, which is my wife and our main partner Darren Light, is on the earnest money side. Would we put hard money down? Possibly, if we can get it at this price. So when we know this market well, if we're confident that we can get it at our price, then yeah, we would do the hard money down game if we have to somehow figure out how to compete a little bit more. But I just think there's capital coming in that has different needs, that is less cash flow orientated and maybe just depreciation orientated. It may, maybe Johnson City, Tennessee is an appreciation market now. I don't know. We like to see a little bit of a blend or significant blend between cash flow and appreciation, and that just keeps us from quote unquote overpaying.
Yeah. No, I definitely resonate with that. I remember the days where I remember touring large multi in Johnson City that was selling at a 7 cap, not all that long ago, right? And I'm sure it's changed dramatically. And I think a lot of the big markets today it's pay to play with hard money, right? I know most major markets, unless you're putting 6 figures hard down, they just won't even look at you, right? Because it's so competitive. So and it definitely is it's interesting how commonplace that's become. It used to be something that showed that you were aggressive and a little bit more confident in the next guy, and it was like a easier way to really like get the seller over the hump. And now it just seems like it's just like an entry ticket to getting into the best and final.
Yeah, exactly. So I mean, some of the other opportunity that we're looking at is just buying smaller stuff close to the properties that we already own. And so we might not get quite as much competition that way.
Mhm. Yeah, I think that seems to be something that a lot of people are shifting towards, is buying smaller multi, because you don't usually have the same level of investor demand. There's not usually as much hard money thrown around. You usually are buying at a little bit of a better cap rate, so you're getting better yields. Sometimes the debt is not always as competitive, but usually the price per unit looks very good compared to where the bigger stuff trades at. And I'm interested to see what that turns into, because I bet a lot of folks like yourself, or other folks that are buying, and the small to mid-size multis, will say like the sub 100 unit stuff. I'm curious to see if that starts to become a larger focus point, is building up portfolios, right? And you almost have like consolidators of that type of multi that then will sell off large portfolios to the bigger buyers as they can start to get better debt terms on it. They can start to place more capital with one swing of buying, 10 different 30 unit deals off of one sponsor. Could you see that being a thing? What do you think?
We might make it a thing. I mean, just for our own purposes of scaling, especially with the property management, we only have 65 units over 2 properties that are 2 hours apart. So we're not benefiting from any scale right now. So it would behoove us to try and grow closer to really both of them.
Yep.
To try and ease up some of the running around, or hire one person type thing. It'll ultimately be like 2 people, but and then it could be a good exit as well if you're able to get a big enough portfolio and find a single buyer.
That's a good point. The operations is usually what stops people from buying in the smaller units, because a lot of people are working with PM companies that only work with 200 plus units, or sometimes 100 plus. So it does take having that nimble team. And I think that's where in-house management really helps you thrive, is you can really do really well on the operation side on smaller unit types, where a lot of the big, PM companies of the world wouldn't look at that level, right? But maybe they'd be more open-minded if there's a portfolio, right, at a certain level, right? It makes it more worthwhile for them to start to get involved, right? So really cool. Now, as far as the RV campground space, I know we worked on the first project we worked on was Arrow Creek, which was spot that is in Gatlinburg, Tennessee, an extended stay. And then more recently, we worked on the Sevierville project, Cove Creek, which is more of a short-term transient RV campground. So both of which, we are super excited about. And we love the market there in the Smokies. So definitely, if our listeners are ever planning to visit the Smoky Mountains, be sure to give us a call so we can give you a spot to check it out. Let's just talk about that space. What initially opened up your eyes to the RV campground world, and how has the reality of the space, how has your perception of the space changed since learning more about it when it initially crossed your plate?
I mean, the perception, I knew nothing about it. And then it all happened in basically the fourth quarter of last year. We very quickly got involved in a couple of projects. It came up in a conversation with somebody. They sent me a link and we realized we were looking at it together. What got me most excited about that space specifically is the market we're in. It is such a mature tourism market in general, but also specifically for the RV space. It gets a ton of visitors, whether they're coming to hike or they're going to Dollywood or if they're going to go see a comedy show. So just the fact that it was an established market, I was much more comfortable about doing an entry into the space because I felt like we had a net below us a little bit. If you're going to try something new and be able to make a couple of mistakes, you want to do it in the market that is favorable. If this is just out in some random county in the middle of Tennessee, I would be saying no all day long, just for the same reasons that we don't buy multifamily out there. It's like,
Sure.
there's nothing fundamentally supporting this thing. It would just have to be cash flowing like hell. From, the asset class, looking at it more recently, it seems to be similar to a mobile home parks and storage was maybe a decade or so ago. And was able to find people that were in the storage space that have gone into the RV space. They talked about it at length, and from their experience, they were remarking on the same similarities of it being fairly unsophisticated, decentralized, a lot of mom and pop owners, a lot of supply and demand. There's just not that many of the parks to begin with, and fundamental trends in the RV industry going pretty well for the past decade or so, let alone last year, where they really took off and caught a lot of people's attention. So we're cash flow buyers. We try to stay in that space as much as possible. So just from the chasing yield type thing, it seemed like this asset class had a lot more cash flow potential to it. So we're willing to do a little pivot. It was interesting. I was listening to a podcast yesterday, and they were talking about animals, and they do a couple things, and we all have this opportunity. An animal will forage and may find some acorns, wherever the hell he's looking for, and then he has a choice to either feast on those or to continue foraging. And so, that was something I was thinking about. We talk about not chasing shiny objects, but I think to some extent, in order to grow, you have to continue to look around. And when you see some opportunity there, if it's throwing something off, you have to make that decision to feast on it or to continue on your way. So we're deciding to spend some time in this field and see what we can gather.
Yeah, love it. No, I definitely agree with that. I think a lot of the times people get started in real estate on one asset type. And I think for many, multifamily, was where I got started. It's where you got started. And it's so ingrained in you, just probably from the people around you, the mentors and, people that are teaching, to just stay like hyper focused. And I think there's a lot of value in being hyper-focused, especially in the beginning, because it takes tremendous amount of effort to actually start to catch momentum. But there comes a point in time where if perhaps you are having trouble, you feel like you fall out of alignment with where the market sits in terms of return profiles, or you're not able to, get behind either where the current yield is or the current, if you're not into putting hard money down and that's what the market's requiring and it doesn't align with you or your values or your expectations, then yeah, I think there's a lot of, benefit in knowing sort of when to begin to look around and then when to focus again, right? And to double down on strategies that seem to be working for you. So can definitely relate to that. I think there's also value in being experimental, right? And I think that's where in real estate, a lot of the real estate world seems very sort of cookie cutter, laser focus on one thing. And there's even on the pro formas, it's not like, oh, we're going to try and test this. It's always like, this is how it is. This is exactly what we're going to do to every single unit, versus like in reality, you have to be much more flexible, I think, to really optimize the return on any deal or the return on your business as a whole, right? So whether that's testing out different business structures, whether it's testing out different types of deals or different ways of different strategies in the operation side of things, I think that there's a ton of merit in keeping sort of that experimental mindset, right? And then determining at the point when you have the data or the feedback to see if there's something that resonates well with me, right?
Mm-hmm. Yeah.
So as far as the RV space, I definitely agree with what you're saying about the market. I think that's a huge driver. What what else excites you about the space? And then what do you think are the biggest risks that are out there for the space?
Well, we talked about before we started recording, and gas prices may put a damper on how far people travel.
Mm-hmm.
But it could just mean they don't travel as far.
Mm-hmm.
So that kind of goes back to the market that we're in.
Mm-hmm.
It's a destination market for multiple reasons. It's just not a campground on some random lake in the Smokies. So there's still lots of reasons for lots of people to come there, even if it falls off a little bit. It'll still be one of the top 3 most visited, national parks
Mm-hmm. Yep.
in the nation. So, I think we'll be fine. And we talked about it a little bit, just in terms of recession, is will people stop camping and they'll just stay home? I don't know. But will people stop flying to Aruba and decide to go camping? Well, I guess that's also a possibility too. So I wouldn't say it's recession proof by any means, because it's not primary residence. But just with the larger demographic trends of people aging out and retiring, and a lot of the world is looking for more experiences, and doing the things like Airbnb, short-term rentals, RV parks kind of is lumped into there. And then just fundamental changes in how the workforce is
Mm-hmm.
playing out, especially post-COVID. Some of that is going to be permanent. So I think we're looking at a net gain when everything finally shakes out. I think the risks are the same that everybody is going to be facing: interest rate risk, that kind of stuff, debt risk. In terms of the business plan, one of them is completely daily rental. I think we analyzed it that it would also cash flow and support itself if we had to revert back to something, more semi-permanent or monthly. So we're not locked into, we can only sell this product, and if it doesn't sell well, then we're going to have problems. So
Yep. No, I definitely agree with you. I think those are all really great points and a lot to hit on there. So maybe we'll just deep dive on this for a little bit to just discuss the risks and some of the common thought patterns regarding the RV campground space. The number one is that I think the people often think that because something, well, first off, even as taking a step back, not every RV park or campground is a destination location, right? Like part of our portfolio are true extended stay, utility focused locations where people are allowed to live full time in their RVs, right? The stuff that we have in the Smoky Mountains, those properties are more destination focused, and that we actually require them to prove primary residence elsewhere if they want to invest into an annual stay. They're not allowed to live there full time, right? Because I think travelers and non-travelers have 2 very different sort of reasons for being there, and different focuses on how they want that experience to look. So it generally is best to keep the 2 separate in our view, right? But just as a first starting point is that not every RV campground is completely recreational. There are also utility RV campground or parks, right? Then speaking more, I think gearing this conversation mostly towards the destination focused, we have to think about, so what are the risks if this is a luxury and they already have a primary residence elsewhere? What's going to keep them wanting to keep paying monthly rent on the RV space that they have, or what's going to keep, because some people do that, right? They treat it like a second home, or what's going to keep them coming back and taking the weekend trips to do their short-term stays and getting the nightly revenues where they should be. And I think when you look at that side of things, you really want to look back at the historical trends of what you've seen. And I think you brought up a really good point that people still have 2 weeks of vacation time and they're still going to do something with that time. And for many people, I think it's close to 10% of households in the United States have an RV, right? I think there's close to 10 million ballpark, probably somewhere in the 9 to 11 million 9 to 11 million total RVs sitting at households in the United States. So they already own these RVs. They already either making payments on them or they have them paid off, and they're going to do something, right? And even if gas prices are going up, they already have $40,000 sitting in equity in their RV, and they're going to want to go to take a trip. Maybe instead of traveling several states away, they go somewhere within an hour or 2 hour radius, right? And so I think you have that working in your favor, that there will always be a consistent flow of steady traffic. And I think I actually just had it up just because I was having this conversation earlier, just kind of keeping pulse on, I think there's so much talks of where the economy is going, things along those lines. And speaking on outdoor recreation as a whole, there was a quote that was made from a major outdoor recreation outfitter back in 2008. And it says, well, early predictors show evidence of a decline in outdoor channels starting in November 2008. Outdoor industry sales have remained fairly robust since the nation officially entered a recession in December 2007. And they posted a healthy 9.6% increase overall and outpacing traditional retail markets, right? And I think when you follow the outdoor recreation space as a whole, that has done historically very well during downturns, and obviously, especially when you have things like COVID. But I think that was sort of a unique downturn in its own way. But then, yeah, so I think it's important to sort of separate traditional hospitality with outdoor hospitality and outdoor recreation, because the two have very different performances during downturns, right? And I think historically, the space has remained pretty resilient. And it's I think a really good comparison is the marina space. I think marinas right now are also pretty fragmented, and they're still in the earlier stages of consolidation. And those also did, no one lives in, some people live in their boat, but most people don't live in their boat. So those have done really well, as also through, if you look at the history in 2008, they performed very well. Because people still needed somewhere to keep their boats, and they still already own the boats, so they're okay paying a couple $100 a month or whatever it might be to keep their boat at the marinas where they're currently stored, right? So and if they sell their boat, someone else is going to need a place to put it, right? So yeah, I think that just first getting a feel for like the history itself, and then thinking through the interest rate risk. I think interest rate risk is the looming risk for most real estate right now. And I think when you're buying higher cap rate real estate, it impacts you dramatically less, right? Because if you're buying stuff that's going to have a 5-point spread on where the interest rates are, it's very different than having a 1-point spread on where interest rates are, right? So you're buying campgrounds that we'll bring to, usually by year 2, 3, you're at a 10 cap, right? Especially if it's more of a recreational destination focused place, and then your interest rates might be half that, right? And that spread, I think what's interesting, if you model it, right, what that like 50 basis points, 100 basis points in cap rate expansion does is very different than watching 50 basis point expansion on a 4.5 cap market if you're buying multifamily in most major markets in today's world, right? So I think that's just something to think about. But that said, I will say that there's not nearly as much recourse financing or non-recourse financing options available, right? You usually have to be at least $9 million loan size. And then you don't have this, you're not going to get Fannie or Freddie debt, right? You're usually looking at CMBS as like your main non-recourse financer. And sometimes you have bridge options available as well. But I think more of the risk in a space like RVs or marinas are that there are not as many, there are not nearly as many avenues for financing available. So if we do hit a tough time, you may have a more difficult time finding banks willing to get behind it, right? Because in general, even during good times, it's still a more difficult asset type to finance. So I think your refinancing risk is not necessarily as caught up in interest rates as much as it is just caught up in who's going to have the appetite at that given time in the market, and making sure that, you know, you're in a position where you'll have that that available, right? And I think as you go bigger, it in some ways gets easier because usually there's always better options available for larger loan types. And even if it's on a portfolio level, I think it makes it a little bit easier. But you know, that's definitely something that, you know, I think about. And I think, you know, our objective is getting extensions early and getting refinances early so that we're not sitting there, you know, at year 4 on a 5-year loan, you know, hoping that we have ideal, you know, conditions, right?
Yeah, I mean, you know, Fed's talking about what, 5 potential increases maybe this year. That's something that I saw. There's a lot of people with IO out there that I wonder what their pro forma said about what rate they would be refinancing at 3 years ago. The market might save them in some other way with compression of cap rates, but yeah, the interest rate risk is, we'll find out shortly, I guess.
Yeah, exactly. So a lot of it really comes back to location, right? That to your point before of that being a safety net, I think that applies to most real estate types. But I think it's extremely important to not overlook, right? And making sure that you're accurately pricing towards the market you're buying in for sort of the risk that entails. I think what you guys have done very well is staying really laser focused on the you know, central to East Tennessee market. So how has that benefited you, and do you see that changing over time? Do you see yourself expanding into new markets? What's the plan?
Yeah, I mean, we do look in the Carolinas, North Georgia, and Kentucky. We've just never bought anything there, but we do consider them our markets. I really do like knowing our markets really well. Just from an analysis point of view, it's easier. From recognizing opportunity, it's easier. From working with other people that are interested in this market, we're able to provide, you know, value as being operators and boots in the ground that can actually go drive to the property and see what's going on. So, you know, we're going to continue to focus in this area. I think as things have gotten more competitive and cap rates have compressed and yields have gone down, that's one of the few advantages, or it's one of the advantages that you can continue to leverage is micro market knowledge. So,
totally. Yep.
Yeah. So, and you know, that's something that I think is instilled in me from my W-2 job. I did the same job for 20 years. I was very good at it because I knew it so well. And there's a lot of comfort that comes from, you know, knowing something well and just being able to do it. And that's tough, you know, that's part of the learning curve with the property management. That's part of the learning curve with getting into the RV space. We didn't have to relearn the market to get into the RV space in, you know, basically Sevier County, Tennessee, because we were already familiar with the market. We just had to put it into the context of a different asset class.
Completely. No, I think that's all great points, and I definitely agree with that. I think there's something to be said about, you know, investing with operators or being an operator and knowing your market extremely well inside and out, right? The more time it takes years to really intimately know markets, right? And kind of know which parts of town you want to be in and which ones you don't, you know, in a really, really refined way. So I definitely think that's something that people can overlook, right? Don't be market chaser as much as being, someone that finds a couple good markets and really spends a lot of time in those markets, right?
Yeah, I mean, if I see something that's on the market for 6 days, when the first question I was like, what's wrong with it? Why is it still available? I mean, because things are moving that quickly. So, yeah, if you're investing from out of state and you don't really have a good knowledge base of the market, you're already a little behind
big time.
the curve. Yeah.
Well, fantastic. Last question before we wrap up here. Can you leave us with one piece of advice for an active operator that is looking into getting into one of their early deals, and then one piece of advice for a passive investor that is looking to passively invest?
One piece of advice for the active people: I spend a lot of time reading books about decision making and biases and heuristics and things like that. So the last one I read was "You're About to Make a Terrible Mistake." Excellent book. The main thing I picked up out of there was that we have processes for moving somebody in and out of an apartment. We have processes for cleaning a pool. We have processes for all kinds of things. We don't often have much of a process for decision making. So that is one thing I'm kind of focusing on, is putting the decision making process. Well, I just said
That's
it.
great.
Yeah. Just trying to make it not necessarily more objective. I guess it is a little bit more objective, but it's too easy to go with your gut or just do things because you don't want to miss an opportunity. Things like that can come back and bite you in the ass. The passive side, talk to other people that have invested with whoever you're thinking about investing. So, do your due diligence on the operators themselves, but I think most of all, if you could find out a way to network with other LPs, there's a lot of networking on LinkedIn. There's a lot of networking on, Facebook. I don't think it's too much of a hurdle to find people that are actually placing money with any particular sponsor, and get a good sense of really their communication level more than anything. You want somebody that's going to communicate well, good, bad, or indifferent. You want a newsletter when nothing is going on. You want a newsletter when things are going terrible. You want a newsletter basically every month, something like that. So yeah, talk to other people that have invested with the sponsors you're interested in.
Yep. No, I love that. I think that's a huge thing. There's a giant LP community out there, and the more you can connect with that, the more I think you'll feel increased confidence, and you'll have someone else to talk to along the way too, right? If things you're ever running into challenges, but hopefully you can avoid them altogether by getting good feedback from other folks that are investing. And I know most sponsors are happy to share a few key referrals and things like that along the way as well. So if you're looking at a specific deal, you really like it, then the quickest path may just be to ask the sponsor, who are a few maybe non-friend or family investors that you have that you may be able to connect with. So
yeah, because I think it's getting so easy to place money now, and it seems like when things get too easy, you might spend less time on that decision-making process. I guess it can go back to spend some time making a decision what to do with your hard-earned capital.
Yep, completely. So what's the best way for listeners to plug in with Real Wealth Solutions and to stay in touch with you?
Yeah, awesome. Thanks. Everything we do is at realwealth.solutions. So we locked into that there was .solutions available instead of .com. So realwealth.solutions. We also host a podcast, the Real Wealth Solutions podcast. We host a meetup once a month in the Johnson City area, once a month in the Knoxville area. So if you're local, you can find information about that on meetup.com. That's the East Tennessee Multifamily Meetup. But otherwise, realwealth.solutions got contact information and things like that there. So that's the hub.
Love it. All right, fantastic. Well, thanks so much for jumping on the show here, Greg. Always a pleasure to connect, and definitely encourage everyone to stay following along with what they're working on, and we'll until next time.
Yeah, thanks, Dylan. Always good to get in the weeds with you every now and then.
All right, take care. Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk, and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.